Volatility. I'm going to talk about implied volatility a little bit here and how it affects the price of options. Some people don't really understand volatility, and you see this a lot when I see it a lot when I look at chat rooms and I see newbie traders who maybe they see the stock price is going way up that day, but for some reason their calls that they bought are going down, and they just can't fathom how this could happen. Well, the way it happens is the volatility. Volatility is coming, is either going out or it's coming up. So right now, what's going on? We're in the middle of a global pandemic. Things are going absolutely bonkers in the stock market, and that's why we're seeing volatility just explode across the board in everything. Here I'm looking at United Airlines. We're looking at an airline stock which normally wouldn't fluctuate more than a couple percent in a day, but lately it's been not at all unheard of to see it move 20% in a day, more sometimes. So I'm going to show you a couple things here. We're looking at currently the price is $37, just about $37. You can see we're looking at I'm looking at the options that are expiring in 15 days. One thing I like to do is I look at the puts and the calls of the at the money strike, and what that does is it tells you this price here. That's telling you what options traders are pricing in for a move in that 15 days. This is basically the equilibrium price of what buyers and sellers, how far they think the stock could move. Okay, so right now we're talking $13.50 on a $37 stock. I mean, that's, what is that, 30%? Yeah, about, close to 30%. And what they're saying is that's a 30% move in either direction. The stock could go $13 from 37, so we're talking $24 all the way up to $50. Somewhere in that range, $24 to $50 is where options traders are pricing in the risk right now. What happens with implied volatility is because there's more risk. Let's say you're an options seller. Okay, normal times right now, 2 weeks to go. Let's say you're looking at the 30 puts. With 2 weeks to go, an option seller normally, that would be a 20% move. He doesn't think the stock is going to drop 20%. Not United Airlines, not going to drop 20% in 2 weeks, right? So normally he would price that at let's say $1. Okay, he'd be willing to sell the 30 puts for $1. He would accept that risk. The buyer who thinks it's going to fall further would be willing to pay $1. So the break-even price would be like 29. And the seller is willing to accept that risk because the stock generally wouldn't move that much, But right now we're in different times, so we're at $37, but yet this $30 put's trading for $4. Okay, basically the seller is requiring much more premium in order to accept the risk that the price of the stock could fall under $30. Okay, the chances of that happening are much greater right now, or are perceived by the market to be much greater. So the price of the option is going to go way up. Okay. It's difficult to talk about volatility just because it's hard for experienced traders. Experienced traders like to sell high volatility. Okay, they sell the volatility very high, and they're able to manage their risk effectively through different ways, either trading the stock back and forth or selling other options, call options against their put options. And basically what they're doing when they're doing that is they're hoping that the price of the stock indeed isn't going to move that much. And they're loving it because they're collecting a ton of premium versus what they're usually getting. Okay, normally if they're going to sell those strike prices that are that far away, they're not going to collect much premium. But in times of very high volatility, they're able to collect a ton of premium. And if they get lucky and over the next week to 10 days to 15 days, the stock doesn't move very much, they're going to collect all that premium. That premium is going to collapse. The implied volatility, as the implied volatility drops, let's say The market doesn't move a whole lot over a few days, and people, the risk, the risk that everybody's afraid of in the market, dies down a bit, then what's going to happen is that volatility is going to fall, and then there's just less, they're going to collect premium. Meanwhile, buyers, the problem is maybe they want to get short because they think the price is going to collapse. The price of the stock is going to collapse. They think it's going to go all the way to $20. So they want to buy these 30 puts, but man, they got to pay a big premium. If the price doesn't move and doesn't move pretty quickly, that premium is going to get obliterated. That $4 that they paid is going to just keep dropping and dropping and dropping, and they're going to lose money on that. Okay, so that's kind of how I just wanted to give you an idea of how volatility affects the price of an option, what it is. It's just basically it's the risk perceived by the market, and that when there's higher risk, a seller of an option is going to require more premium. He's going to require the buyer to pay him more to accept that risk. So that's volatility, and that's just a basic rundown of kind of how it affects the market of options. Thanks for watching.